Now, if we look at the S&P 500 as a measure of economic activity in the US and, of course, representative maybe of Western markets generally, we can see here that we've had a massive cyclical recovery since 2009. Remember I said the market doubled in value, more than doubled in value since 2009, and certainly that's been a reflection of some economic growth, arguably which may have been driven by quantitative easing, so governments printing lots of money and supporting the economy and the markets. But the key thing we need to keep in mind is that this market is now looking overextended both in price and time terms. Now, price terms, the 2008 peak coming in at 1440, which we have pushed above, but we still need to sustain above that level convincingly, and I'm still monitoring how convincing this move is. And of course, the 2007 peak, which comes in at 1576. These crisis peaks are likely to be critical on the current rise, which has already doubled in value since 2009. Now, in my opinion, although this is very bullish, we just have to keep in mind that that there is a lot of overhead barriers to come. The risk-reward profile for actually adding new long positions in the market are very poor. The risk-reward environment at the moment is quite poor. If you had been invested from a year or two ago, you would have made good money. Getting invested now is probably too risky for most people, and it's probably a better opportunity to actually take profits if you've already made some money in the market. So generally speaking, in price and time terms, the US stock market specifically is looking very overextended. I'm showing you the crisis peak there from 2007, 2008 as being key pivot levels, but also look at the time axes, which is often ignored. The bear market rally is much more larger than average cycle durations. And keep in mind, the longer we stay within this bull phase, the faster and the harder the retracement will be if indeed we get a retracement in this market. So the longer we stay in this bear market rally or this cyclical recovery from 2009, the day that this trend reverses, it is likely to be much sharper than usual because we spent so much time on the upside. Now, there is a reason why I still believe this is a temporary cyclical recovery and not a long-term recovery, as some of you trend followers may be believing, since we're so close to the 2007 peak, is of course because of the long-term trend which remains bearish. And if we use S&P 500 as a proxy, we can see here the S&P 500 all the way back to the beginning of the decade, 2000, and we can see here for 13 years the market has been moving sideways. And certainly along that sideways neutral range, we've had a lot of volatility, and we've had big stock market crashes. In 2000, we had the technology crash, and 2007, when we had the credit crisis, financial crisis, all take place, and the retracements were roughly 50% to the downside, very short, sharp, and dramatic. And now we're in the next phase. I put a quick question mark as to what happens now. Do we see new highs, and this then opens up into a whole new bull cycle, or is this a temporary cyclical recovery within a long-term bear trend, which is likely to retrace at some point this year, certainly into next year? So my belief is what I just said, that this is a temporary cyclical recovery. Yes, the market doubled in value since 2009, but if we look at it over the last 13 years, this is still within a long-term sideways range, which is still susceptible. It's still potential to see a sizable shock similar to 2007 to 2008. It doesn't mean that we test the lows, but it does mean that we could see a 10 to 20% correction very quickly. I think the middle of this year, summer of this year, there seems to be a very important cycle shift, which may actually help trigger that reversal from these overextended high levels. Anyone has any questions on this? Okay. Getting a question just saying market doubles or dollar loses value. Good question. I think I think the dollar actually is likely to come into its own for a number of reasons. So I think this is more a stock market play, not so much the currency effect. Although it's a good question, Jana Abraham, they're just asking about the drivers for this rise in stock markets. Now, if we look at the last 100 years of trend history, and these are some of the dates. This is the Dow Jones going back for 100 years, and this is just showing you that trends do exist back as far as 100 years, and they tend to last 16 to 20 years. Long-term generational trends. Our professional careers tend to last for 16 to 20 years, and so within each cycle we have an experience of booms and boom times and consolidation phases, and so this is what allows these cycles to alternate from bullish to bearish and bullish to bearish. And here we have 2000 to 2013. It's still 13 years. We've certainly completed half the cycle, but we still have a few more years left in the cycle if we use that benchmark average of 16 to 20 years. We could still see markets within this kind of volatile environment with pockets of opportunities, but generally we're within a 16 to 20 year long-term sideways cycle. Similar to what we saw in 1966 to 1982, hopefully not similar to what we saw in 1929 to 1945, and for some of you history buffs out there, in the early 1900s, during the canal crisis, we also had a secular bear as well. Of course, 1929 was the Wall Street crash and the Great Depression. 1966-82 was more high inflation, and a number of political issues which took place during that time. Okay, now this chart is just giving you a very big picture, long-term perspective as to how long these cycles last. And as I just said, 16 to 20 years. So just keep in mind that whether we get short-term or to medium-term bullish or bearish trends, the very big picture, the very macro picture, is suggesting that we still have further long-term sideways movements and volatility to come.